bond markets are sending shockwaves across the globe. In the UK, 30-year gilt yields have surged to 5.69%, a level not seen in nearly 3 decades. This isn't just a number on a chart. It's a flashing warning sign that the cost of government borrowing is spiraling out of control. Meanwhile, in the United States, the Federal Reserve is under unprecedented political pressure as President Trump moves aggressively to influence monetary policy, creating fears that central bank independence may be breaking down. Gold and silver are soaring, smashing through records as investors flee traditional safe assets. This is more than a financial story. It's a global turning point. The UK bond market breakdown. The surge in UK gilt yields has rattled global investors. For context, a 30-year gilt yield at 5.69% means the UK government is paying a punishingly high rate to borrow money. This will directly impact public spending, from infrastructure to healthcare, and could force severe austerity measures. Markets are questioning the sustainability of the UK's fiscal policy, especially as inflation remains sticky and political instability continues to haunt Westminster. We'll look back at historical precedents, such as the 1997 bond market shock and the 2022 Truss budget fiasco, to understand the risks of today's situation. The big question: is the UK sleepwalking into a debt crisis that could rival the Eurozone debt spiral of 2011? Gold and silver as the new safe havens. As UK yields surge and confidence in government debt collapses, gold has skyrocketed to over $3,500 an ounce, an all-time record. Silver is not far behind, breaking out to levels unseen in more than a decade. But this isn't just a fear-driven trade. Central banks around the world, particularly in Asia, are hoarding gold at record levels to diversify away from the US dollar. Silver's rally is driven by both investor demand and industrial use, as it plays a critical role in solar panels, electronics, and batteries. This section will unpack why investors are flooding into precious metals, what it signals about faith in global currencies, and whether this could mark the start of a new era where gold and silver once again dominate global finance. The Fed under siege. Across the Atlantic, America's central bank is under siege. President Trump has escalated his attacks on the Federal Reserve, culminating in the dismissal of Fed Governor Lisa Cook. This raises fundamental questions about whether the Fed can remain independent in its decision-making. Historically, when politics and central banks collide, the results have been disastrous. From Nixon leaning on the Fed in the 1970s, which fueled runaway inflation, to Argentina's repeated crises triggered by political meddling. Today, investors are terrified that the Fed may be forced to cut rates prematurely, reigniting inflation, or hold rates too long, pushing the U.S. into recession. Either outcome is destabilizing. This section will analyze the Fed's current dilemma, the risks of political capture, and the global consequences if the credibility of the Federal Reserve collapses. Tariffs, trade, and retail pain. Adding fuel to the fire are tariffs. With ongoing legal battles over the legitimacy of Trump's tariff powers, global trade hangs in the balance. U.S. retailers like Walmart and Best Buy are already sounding the alarm, warning that tariffs are raising prices and squeezing consumer spending. This isn't abstract economics. It's showing up in higher grocery bills, more expensive electronics, and households cutting back just as the holiday season approaches. If tariffs expand further, the result could be a double blow: higher inflation and lower consumer confidence. We'll connect these dots to explain how global trade wars feed directly into the volatility we're seeing in bond and currency markets. The global domino effect. The crisis isn't confined to the UK or the US. In Europe, France faces political paralysis, undermining investor confidence. In Asia, slowing Chinese growth continues to spook markets, while emerging markets reliant on dollar-denominated debt face skyrocketing repayment costs as yields surge. Global interconnectedness means a bond shock in London can ripple through New York, Frankfurt, and Shanghai within hours. This act will dive into how investors are repositioning portfolios globally, why sovereign debt crises are contagious, and what lessons we can draw from past meltdowns like the Asian financial crisis of 1997 and the Eurozone debt crisis of the 2010s. Scenarios for the Fed and markets. All eyes are on the Federal Reserve's next move. The upcoming jobs report could determine whether the Fed leans toward a rate cut or holds steady. But with Trump exerting pressure, the risk of a politically motivated decision is higher than ever. We'll analyze 3 potential scenarios. 1. The Fed cuts rates to calm markets, boosting short-term confidence but reigniting inflation. 2. The Fed holds steady, keeping inflation contained but triggering recession fears. 3. The Fed splinters under political pressure, losing market credibility altogether. Each scenario carries risks for equities, bonds, commodities, and currencies worldwide. A system under strain. September 2025 may go down in history as the month global markets hit a breaking point. The UK's surging bond yields threaten fiscal collapse. Gold and silver are screaming that trust in currencies is evaporating. The Federal Reserve's independence is under siege. And consumers worldwide are being crushed under the weight of tariffs and inflation. The financial system is straining at its seams. The question for investors is not whether volatility will rise, but how prepared they are to navigate it. This is not the time for complacency. It's the time for vigilance, diversification, and realism. If this breakdown gave you clarity on today's chaos, smash the like button, subscribe for more urgent market analysis, and share your thoughts in the comments. Is the UK spiraling into a debt crisis? Is the Fed losing its independence? And is gold the only safe haven left? Your perspective matters. Drop it below, and let's prepare for the financial storm together. This is Felix. See you next time.